All of a sudden into Wednesday, there's a lot more risk hanging in the balance, which could weigh more heavily on sentiment in the sessions ahead. Economic data won't get that much attention in light of this fact, though it's worth noting we get German factory orders, German construction PMIs, US ADP employment, and the Bank of Canada policy decision. As far as those bigger risks go, let's run through them. The pound has done a fabulous job recovering in 2017, getting help from broad-based US dollar selling and a Brexit outlook that has been looking less and less scary. Over the past week or so, there's been a fresh wave of optimism towards Brexit, with the market feeling good about a deal getting done on the divorce bill. Both sides have expressed confidence, and this has fueled more demand for the pound, with the cable rate pushing back towards its 2017 high from September at 136.60. However, there have been some bumps this week, with the Irish border standoff still hanging over the deal and uncertainty creeping back in as a result. This will need to be closely watched, though we continue to retain a buy-on-dips outlook for the pound, with the ongoing view that despite more bumps along the way, the two sides will be able to keep pushing forward productively. This takes us over to the other side of the Atlantic, where there's a whole other mess of risk right now. The market isn't feeling so good about tax reform all of a sudden, with lots of talk of a watered-down tax reform if the 20% alternative minimum tax rate is preserved. We also have renewed headlines surrounding the president and Russia collusion narrative. As reports make the rounds, the investigation will now include President Trump's business dealings. And on top of all of this, there's this other story that usually commands a lot more attention, which is the possibility for a U.S. government shutdown if Congress can't agree on a spending bill by this Friday. It seems the market is too much on its hands right now to contemplate the risk, while also assuming we'll get that same 11th hour deal or extension that usually plays out, given no one really wants to see the government shut down. Nevertheless, when it rains, it pours, and this is a risk that should be monitored. European political stress and geopolitical tension are just some more of the raindrops in the mix, and this in conjunction with a super extended global equities market onset of policy normalization and a cryptocurrency that has just surpassed the market capitalization of Citigroup could make it all a little more unsettling going forward. Earlier today, Aussie GDP disappointed and has resulted in relative underperformance for the Australian dollar. That's all for now.